Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are looking at the Altria Group, ticker MO. This is a very strong dividend stock. I feel like this is going to be a relatively quick video looking through the numbers and the earnings. I already am fairly certain this is going to be a sell rating. You can see in here the chart. We have been on a downtrend essentially since 2019, just trading in this wedge here. Mostly within the range between 41 and 48, bouncing in between there a lot, breaking up above, coming right back in. So there's not a whole lot to get from this chart. It tends to be a very stable stock, kind of trending down but sideways. And let's look into the numbers and see what is going on with those. Here we have the numbers as of the end of last year. And we see there's a bit of red and yellow throughout here. Honestly, the financials are not half bad, but the balance sheet is terrible, which contributes to the shareholders' equity as well. So we'll start very low minimal growth, not outpacing inflation, of 1.4% year over year with a 2% drop this last year. They are bringing down their cost of goods nearly 3% a year, 9.5% this last year. Their gross profit is slightly climbing, up about 3.9% every year, nearly 1.8% this last year. Net income, they flipped from a negative in 2019 to a fairly solid positive in 2022. So that is something that they've been able to drive better. Expenses, they have been able to cut their expenses nearly 2.7% every single year. A huge drop this last year of 10%. Their EBIT has not been rising though. It has been dropping about 6.7% year over year, compounding with a move from nearly 10.5 to 8.5. Their gross profits are solid and relatively stable in the 60s. Beginning in the low 60s and ending in the high 60s with nearly 2.4% growth year over year. Net income moved from a negative to a positive, but just like the dollar value, the percentage is moving very nicely. Earnings per share, they were negative in 2019. They have moved to $4.84 a share, which is a very strong move. They currently sit at a PE ratio of 9.42. which, based on their historical performance, would put them near $100. And going forward, analysts are expecting $5.04 in earnings per share this year, which would put them at 112.5 or so. Their assets have been shrinking. Their liabilities have also been shrinking, but to a lesser degree, and their numbers are very close together, which is not something that we want to see. And we end up with a negative book value that is growing even more negative every single year. So we can't even get a valuation off of that. For free cash flow, they're very strong on their free cash flow. They have been growing it nearly 2% a year. It did drop 2.25% this last year, relatively stable around the $8 billion level. Which would give a fair value around $90 to $93 going forward. The share count, they have been purchasing back shares a little over 1% a year, 1.32 year over year, and 2% this last year alone. Shareholders' equity, this is the biggest red flag for me. The fact that this is red, meaning that shareholders are like strictly owning debt of this company. There's so much debt, and just the market cap of this company, it's taken negative. So typically we see a shareholder's equity here where we can break down per share the actual tangible value of the company that you own. Well, for this, you technically owe money. So that is definitely not something that we want to see. And just for that fact, between that and the book value, I'd say this is a sure sell because you're not really owning anything here. Like I said, this balance sheet is a mess. The financials, not half bad. Pay a strong dividend, 8.25%. That's what they're known for. That market likes them around 7.5%, it seems. So we'd be looking at $110.5 for that. And then across the actual financial numbers of the stock, we'd be looking at somewhere in the $90 to $100 range. But once you factor that balance sheet in, I don't think it's something that I'd really want to even touch. Definitely would help to cut that valuation in half, which is where the stock currently sits. So off current financials and the dividend, it can probably sustain what it has, because as Peter Lynch said, the dividend helps to keep a bottom in the stock, because if the price starts to drop, more investors will come in to scoop up the yield, and they'll help hold the stock at a certain level. We can take a quick peek at the earnings that they came out with recently and see what we think about those. But off the bat, if we start off with negative revenue growth, it's definitely just, they have to be driving more volume in cigarettes to grow as a company. And if they're not able to do that, then it's not even worth our time here. We have the earnings. So right off the bat, we see a decrease of 2.9% in revenues. So that's the main thing that we were looking for, and they did not deliver. We'll see if they're able to deliver as the year goes on, but they are not off to a good start. They really enjoy returning cash to shareholders, paying $1.7 billion in the first quarter in dividends. The Juul transaction was a flop and really set them back, held them down. But they are working to pivot to smoke-free products, and they're trying to bring long-term growth. Their guidance for the year, they're looking at expected earnings per share of somewhere between $4.98 and $5.13, which is about in line with what analysts are expecting. So that would present some decent growth for the earnings. On the low end, that's up 10 cents from last of their products. So we see cigarettes. They saw an 11.4% decrease in cigarette volume. Cigars saw a 2.3% growth. So in total, smokable products declined by 11.1%. Their oral tobacco products, they're really driving, from what I had seen, that is up 37.7%, but the rest of that portfolio is down, which brings them to a total of a 1.8% drop in oral tobacco products. Here's how you know that it is a risky investment, and the government could turn on them very quickly and basically destroy most of their business model, or at least disincentivize it. So here are all of their warnings to investors, which is not something that you really like to see. With risk can come reward, but in other times, risk is just risk, and you could lose a lot of what you put into it. Here we have the balance sheet. We see that assets are down and liabilities are down a little bit as well. Total debt is down. So all in all, my thoughts, I think that it's going to take some time to see their pivot away from smokable products into smokeless products. And we'll see if that's even something that's really accepted across their consumer base. And if they can't drive that top line revenue, there's only so much that they can do to cut costs and drive their earnings. So that's what they've been doing, is just working on cutting those costs, which is driving earnings and market value in a sense, but their balance sheet needs a complete overhaul, and it'll take a while before it's something that I would consider again. I want to thank you guys for watching this. Please like, comment, subscribe. Let me know what stocks you want me to take a look at, and I'll catch you next time.